Nancy, great to have you with us. This
Thank
is
you.
sort of the playbook. I mean, if you're in a rising inflation, rising rate, rising dollar environment, small caps historically have done well. Have we seen that sort of play out in which sectors in particular, or I should say subsectors within small caps, do you like the best for this environment?
So we are starting to see that play out, certainly in the third quarter, which was, by all accounts, a very frustrating, very difficult quarter for all areas of the markets. We saw small caps and, interestingly, even micro caps outperform on a relative basis. And small cap growth and micro cap growth were two of the only sectors that were actually up a little bit for the quarter. One of the other factors with small caps here is not only are the stocks very attractively valued, selling at valuations of 10 times or less in aggregate on next year's earnings, and admittedly those earnings might be too high, but that's still a great valuation. We have also seen historically that it's not really rising inflation so much as inflation that is high, leveling out, and starting to come down, which is the scenario that we think we are entering today. So that bodes very well for the outlook for this very neglected sector of the market. And if it, as your previous guest just said, we're right, and we're going to go into a market that rewards individual stocks as opposed to macro themes, that will be even more tailwinds for the small cap sector. In terms of specific sectors, we are very, very bullish today on industrials. We believe that we are entering what we're calling a new industrial revolution, driven by the multiple factors of the energy transition, reshoring, friendshoring, nearshoring, all of the different kinds of shorings, the infrastructure rebuild that we're seeing in the United States, as well as an increase, a likely increase in defense spending in the U.S. And industrials are a large part of the benchmark and a large part of the universe in small cap land, and provide myriad opportunities for both growth and attractive valuations.
How do you think, though, you mentioned the valuations and based on estimates, which might have to come down still. So how do you think about, how much estimates might have to come down, and what are sort of your what's your North Star in terms of telling you that it needs to come down by X amount? I mean, when we're going to go through earnings season, so are there certain bellwethers that you're looking to?
So it's very tricky to know exactly how much estimates need to come down, of course. We need to know how deep this recession is going to be, or if, in fact, we can manage to just have a bumpy landing as opposed to an actual recession. What we look for, though, as we go into these recessionary or very slow growth periods is how do the stocks react to the inevitable disappointments? And it was a good day yesterday, but you can look at the reaction to Applied Materials earnings. When stocks start to react positively to bad news, that's a sign that the stocks are more than adequately discounted. The way we approach that is we stress test all of our estimates. We look at past recessionary periods and try to get a sense of the incremental and decremental margin. And we do this actually both on the up and the downside to get a sense of how much estimates need to fall. With the benchmark selling at something on the order of 10 times earnings, if earnings come down 20%, that's still an attractive valuation.
Okay, Nancy, great speaking with you. Your picks are Alpha Tech, Acuity Brands, MRC, and Sterling Infrastructure. Talk to you soon.